that maybe the labor market is a little bit less hot than it was so far is the unemployment rate, and that is where they are looking at. Gonzalo Cañete, Head of Global Market Strategy for ATFX Connect. Good afternoon.
Good afternoon. How are you? How are you, Marta?
Well, how did you see this employment data on unemployment in the United States? Non-farm payrolls creation of almost 300,000, much higher than what the market was estimating. Unemployment rate up 0.2 of a percentage point. Alexis told us maybe there is something that they are not telling us, and that is happening in the labor market because of the disparity between unemployment and the creation of payrolls. Disparities, but it is still striking, isn't it?
Yes, but in practical terms, that is to say, for those of us who are simply following the data that is released, the data is created in different ways. Following the data that is released and how the market reacts to it from a speculative point of view, what we see is that this usually happens. That is to say, we have already seen more than once that when they give good data, the other is negative and vice versa. For example, if the non-agricultural payrolls had been a little weaker, I am sure the unemployment rate would have been good. So we always seem to have that contrast between the two. Why that divergence of data occurs, we don't know, but it's certainly striking in my opinion. I think what they are trying to do is to neutralize the effect that the employment report has on the market by taking out this same data, But the overall reading, especially for people not to lose their minds, is that the unemployment rate in the US is still below 4%, which is impressive, that the inflation rate continues to be stagnant, because if you go back to the end of Q4 of 2023, up to now, the inflation rate has practically not moved. That is to say, it goes up X tenths of a percentage point and goes down again X tenths of a percentage point for each month. Therefore, inflation becomes sticky, it is stagnant, the unemployment rate is still below 4%. So it continues to show a very strong labor market, And as a reminder, which I was reviewing simply now I insist so as not to lose track, to have a good chronology, we have seen that in recent years, we have reached unemployment rates similar to these, below 4%, back in the year 2000, that is just before the dot-com crash. Back in the year 2007, we were not below 4%, but we are in areas very similar to these. And before that, around the late 1960s, that is, the United States has never had unemployment figures below 4% like the ones we've had in the last 2 years for many years. And coincidentally, right? And just to throw the paranoia out there for all of you who are following the stock market, is that in 2000 and 2007 is when we have seen these unemployment rates. For a trader who trades, for example, VIX volatility of the volatility index, what we usually say is that when that volatility index falls to lows, it means that something is coming. And in this case, if we were to follow as a volatility index that stop rate, to see unemployment rates below 4% means that they are the prelude of an aggressive upturn in the unemployment rate, as happened in 2000 to 2001 and as happened in 2007 to 2008 with the crash of 2008. So, well, Marta, I hope that doesn't scare the audience too much, but it is an interesting fact.
What do you expect from today's session, Gonzalo? Do you expect it to be a session where, for example, new highs are going to be set in some of the US belts?
That would be most likely. In fact, tonight we have the Wall Street close here on Business TV to analyze everything that's going on, but most likely what we said on Wednesday was, if the US employment report comes out positive, and we can take this as positive in the sense that if the unemployment rate picks up, it's positive for Google Street. That is, a weakening labor market is a key factor in the markets pulling, a fundamental factor for the markets to pull up. And I explain why. The Federal Reserve has put a lot of emphasis. We've seen that the inflation composition, that persistent inflation that we have, you know perfectly well that it's produced primarily by the services side. The services side is a sector that has high use of employment, and therefore, as long as inflation is based on services, on the services side, services inflation, means that as long as the unemployment rate does not increase, that inflation on the services side is not going to adjust downwards. And if it does not adjust downwards, they need a rise in unemployment and a weak US labor market to make sure that inflation will not return, to make sure that inflation will not come back, and therefore to cut rates quietly, rates in a leisurely fashion. The Fed, in other words, and in a nutshell, is waiting for bad data from the labor sector, from the US labor market, as if it were water under the bridge before cutting rates. If there is no weakening in the labor market, they are going to come back again with the same excuses they are giving so far. Well, it seems that we are still far from that 2%, that maybe cutting rates too soon will be counterproductive. All these fears, I think they come from the US labor market, and this data being a negative figure that slightly raises the unemployment rate will be interpreted as something positive by the market.
Well, Gonzalo Cañete, thank you very much. We will soon have the opening of the session, and we will see how the market performs.
To you.